Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com tells us about the Canadian dollar's drop during ongoing trade negotiations. Whether it can hold up likely depends on the oil market. Wolf Street's Wolf Richter looks into the automotive sector and the impact of subprime loans, real estate, and what the yield curve situation is and what it might mean. Ed Steer from EdSteerGoldandSilver.com digs deeper into the issues surrounding the precious metals. He also has the latest from the Gold Antitrust Action Committee. Plus, at the end of the show, we'll have company showcase updates from American Manganese President Larry Reaugh, Aben Resources CEO Jim Pettit, and Carl Data Solutions Greg Johnston. We'll talk to Ross Clark right after this.
Vatic Ventures Corp. is a potash exploration company focused on the Korat Basin in Thailand, the world's largest undeveloped potash resource. Vatic's management has extensive potash exploration and development experience in Thailand. Vatic will have marketing advantage compared to Western producers. Drill program commences this spring. Vatic trades on the TSX Venture, symbol VCV, and on Frankfurt, symbol V8V2. Visit our website, vaticventures.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. Welcome back to This Week in Money, Ross.
Pleasure to be with you, Jim.
The Canadian dollar, a bit of a rough ride. Is it because of uncertainty surrounding the NAFTA negotiations?
Yeah, I would think so. You know, the dollar's had a pretty reasonable summer. You know, we come up about 2.5, 3 cents off the lows, but then got to the middle of the week, and the negotiations at that point were starting to run full force again as far as Canada and U.S. were concerned. And by the end of the week, dollar given up a good 3/4, maybe a full cent off the high. Little anxiety going into the weekend, and then, you know, as it turns out, the negotiations didn't come to any conclusions, and they'll be meeting again on Wednesday. And you know, it looks like nothing's happening as far as the supply management and agricultural side of the equation. But, you know, I'm a technician, so I look at it and say, you know, what normal relationship should we be seeing with the currency? And we would like to see it rally with oil, which is what it was doing into the middle of the week, and then as it rolled over. The oil market has stayed reasonably firm. We're up around 69 3/4 for the U.S. West Texas intermediate price. And you look at the commodity index, it's had a good 3-week run and closing at its best levels of the last couple of weeks. So with strength in commodities and nothing in the Canadian dollar, that's a red flag up here. And I would suggest that as we move through next week and negotiations gear up again, that if oil stays up and the Canadian dollar can't make back the loss that it's had here, then that's going to be setting up for a decent leg to the downside. And, you know, if I look at the commodity side of the equation, we've had, as I say, this nice little run up in the oil price. It's recovered about half of the loss that it had from that July high. And if you recall, we were up around $75 a barrel. Took a hit to 64 and change, now back at 69 3/4. So that's a 50% recovery. We've had 9 consecutive days with good upside bias in through Friday. So that can set up some short-term vulnerability as far as the oil market is concerned. And from a seasonal perspective, oil has typically will top out in September and then see some pressure after that. So, you know, maybe oil's had the better part of its move off the bottom and could help take the Canadian down if it reverses.
Precious metals, any movement there?
Well, we had that nice retracement rally a week ago. The gold market held the bulk of the gains. Silver has not. Silver has been reasonably weak. And if we look at the commitment of traders numbers, see that there was a small reduction in that very overweight position on the gold market. We had one of the largest net short positions by speculators. Well, I guess you have to go back to 2001, 2002 to find numbers like that. And those subsided a little bit. We're still about 5,000 net short. A decline of about 5,000. So we're net short about 3,000 contracts right now on gold. That's not enough to have been a big clean out, and I would suggest that gold could still have a reasonable short covering rally from here. Still thinking that you get up into the 1250 to 1270 range is a possibility. On the silver, the shorts keep increasing their positions on the spec side. We've now got a net short position of 15,000 contracts. So the bears are more adamant as far as the silver is concerned.
And we'll be digging deeper into gold and silver with Ed Steer later on in the show. Ross, interest rates, everybody's still waiting to see how many more interest rate hikes are on the way. Any indications from your side?
Yeah, what we're seeing is that the meeting at the end of September, there's almost 100% chance that there'll be a rate hike there. The December meeting, there's now sounding like a far less chance of that happening. Interestingly, if you take a look at the and we've had still a flattening of the yield curve. We're down to the point now where the 2 years versus the 10-year curve is at about 19 points right now, and that's the lowest that we've seen it in a number of years. It'll be when the curve gets closer to or inverts and then starts to turn that will be a big caution signal as far as the equity markets are concerned. But when I look at the bond market, I look at the 10-year note. There you've got just huge short positions as far as the specs are concerned, and the price pattern is a really nice looking base that we're seeing over here. The TLT, which is the ETF for the 10-year note, that had a selling climax back in the early part of the year. And a good bounce, then went back, retested the lows, and did that 3 times as we've moved through the spring and summer. And we're around 121 on the TLT right now. Resistance is up at 123. If it shows some sign of strength, that would be with a rising price and some increasing volume. This thing has a chance to make a pretty good run. I would think up into the 128 range. And for people in the bond market, that's a big move. So even though the short-term rates may still have a rise and a push there from the Fed, the bond market itself is looking like it's trying to base out in here.
Ross, thank you so much for the update.
Good to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. Coming up, Wolf Street's Wolf Richter, next on This Week in Money.
Always consult your investment professional before making any investment decision.
Aben Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN.AF. Surrounded by world-class gold deposits and mines, Aben's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at abenresources.com.
Media recognition from Bloomberg, Reuters, Recycling Trade Publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with Wolf Richter, the founder of wolfstreet.com. He's speaking to us from San Francisco. Wolf, welcome back to This Week in Money.
Thanks for having me back, Jim. Always a pleasure.
Wolf, is credit tightening making it tougher to buy a vehicle?
Yeah, in the United States, there's really two levels in terms of credit, and at one level we have the prime customers, so the people with reasonably good, very good credit scores, and they have no problems getting funded for a car loan. And interest rates have come up a little bit, so loans are not that cheap anymore. But they're getting funded no problem at all. On the other hand, the subprime borrowers in the United States, they have been getting loans very easily starting in about 2014. And special finance firms sprang up that specialized in subprime auto loans. Subprime auto loans were securitized and sold as asset-backed securities to other investors. So that's how they got rid of those loans and funded more loans. Some of those smaller specialized vendors borrowed from banks to then fund those car loans. And there's a lot of them. And some of them are backed by private equity firms. Some of them are publicly traded. And they became very competitive and chased down these subprime customers. And the reason is this, a subprime customer, when you walk into a dealership with a bad credit rating, there's a good chance you're going to get turned down for a car loan. And when the dealer says, okay, you sit in the finance office, you picked out the car you like, you sit in the finance office and the dealer says, or the finance guy says, well, your credit looks pretty lousy and the best I can do is a loan it'll cost you $300 a month, and then you look at the interest rate and it's 15%. And a normal person, normal meaning a person with a normal credit rating, so with a median or higher credit rating, would just get up and walk out. Now, because that's ludicrous these days to pay anything in the double digits for a car loan, even 6% or 8%. You just wouldn't do that. You just leave. Or you negotiate. But with subprime customers that have been turned down before and they know they have a problem and they know they have they have a default on their record and some other things. So, they're not likely to shop and they're paying these huge interest rates, and dealers and, lenders make a huge amount of money on subprime loans. That is an incredibly profitable business. It's a very risky business. That's why a lot of lenders don't get into it. But those lenders that specialize in it, they make a huge amount of profit. And they did in 2014, 15, and 16. In 2016, the early generations of those loans started to default. So the greed came home to roost. And in 2017, there were massive defaults in the auto loan subprime sector, hitting financial crisis levels. And in 2018, earlier this year, we had the first smaller specialized lenders collapse. And as a consequence of all this, subprime lenders have tightened up the lending. They have, because now they're seeing the losses, the huge losses for them, and they've become much more careful. And that started last year. And possibly at the end of 2016, but really last year, and it's going into this year. And it is very difficult for subprime rated customers now to buy a new vehicle. Yeah, they can buy, but it'll be something cheaper, and they have to possibly put more money down. And it's not going to be a $35,000 new car, but it may be a $10,000 used car. And they're still paying a lot of interest on it, and they're still having huge payments on those $10,000 cars, And so that is, in my opinion, partially or maybe solely responsible for the decline in new vehicle sales, because we have really pulled the rug out from under the subprime rated customers when it comes to new vehicles. And there the credit has really been tightening. And that's a good thing, selling somebody a car they can't afford it and charging them 15% interest on it or 10% even it's a greedy thing to do. and it dooms the customer. They're going to have a default. Nobody can pay off a loan like that. The only hope is that you can sell the car or refinance the loan or do something else with it to get out from under it. And that these excesses of 2014, 15, and 16 are now being unwound, and at some expense to the lenders and the creditors. And at the same time, subprime rated customers are finding it harder to finance new vehicles, and they're having to step down to something cheaper. And so that is definitely like credit tightening at that end of the curve. However, among prime customers, there is no tightening of the credit at this point.
Well, would it be a temptation for these people with 8 and 9 year car loans to just walk away, literally just leave it on the street and walk away from it?
Yeah, and that's how that's happening. I probably wouldn't walk away from it voluntarily. They'd drive it, they stop making payments, and then the repo guy comes out and repossesses it. So one day they leave work and the car's gone, or they look out the front window of the house and see that somebody's towing the car away. And they know what's happening. They know they've been behind for 2 or 3 months or 4 months, and the banker has been calling them and the collection agency has been calling them. So now the car's gone. Yeah, and they don't have a vehicle, and it's a tough situation. When in North America, if you in most cities, if you lose your car, you have trouble getting to work, you have trouble taking your kids to school, you have trouble buying groceries. There's some people who live in big cities like San Francisco or, in Manhattan, or maybe in central Toronto or someplace, it's a little easier to use public transportation, but in most other places it's nearly impossible. And people have to have a car to get around to work, to make money and do the things they normally do. So a repossession like that is a very tough thing, and it should be avoided at all costs. That's why these subprime auto loans are so reckless, because it's greed that causes that to happen. It's a very profitable business, and you end up with a family that suddenly doesn't have a car, that has a huge loan, a lot of interest, a lot of penalties, and another default, and it gets more difficult. This should not be the course of the way things are done in the car business. But subprime lending has been around forever, and it's a risky business, and it's a very profitable business. It goes in waves, Once the risks come home to roost, it becomes a very expensive business suddenly, and lenders go under, and the subprime lending dries up, and that's the state we're in. And people who have bad credit, who haven't paid their vendors before, their focus should be on cleaning up their credit, on sticking to their commitments, and to not engage in any high interest rate loans like that, because that's just going to make the situation worse. If you know you have shaky credit and you're taking on a $35,000 loan with a 10% interest, just to have that nice car, you're setting yourself up for even more trouble. And so people need to be smart about that on both sides.
Moody's has downgraded Ford bonds to one grade above junk. What does that tell us?
Well, in 1997, if I remember right, Ford issued a century bond. So a bond that matures 100 years from then on. And during the financial crisis, when Ford was about to go out of business, that bond traded at 14 cents on the dollar. And whoever bought it at 14 cents on the dollar made a killing, because now the bond trades at around 130 cents on the dollar. And back when you bought it at 14 cents on the dollar, you bought it at a yield of something like 40 or 50%. More, 60%, something like that. Is huge. And and Ford didn't go out of business. So, it didn't go bankrupt either. In a bankruptcy, you would have gotten some recovery on that bond, but not a huge amount, like some of the GM bondholders got some of their money back. So now Moody's downgrading Ford, but Ford is not nearly in as bad a position as it was, before the financial crisis. Ford has been profitable. It's made a lot of money. It's paid down some of its debt. Ford has, it's not that Ford has financial problems. So if that 100-year bond goes back to $14, I might be thinking of buying it, but that's not happening. It really didn't take much of a hit. It took some hit, but not much. Ford doesn't have a huge financial problem like it did during the financial crisis. What it has is an operational problem. Its business in China has been collapsing for years. Now its business in Europe is deteriorating, it's losing money there. Ford just got crushed in China. China is is a huge car market, number one car market in the world. And Ford lost like 50 or 60% of its sales there, even while sales boomed for everybody else over the past 4 years or so. So, Ford completely missed the train on this. Now in the United States, it's trying to restructure its business. It's got a new guy. There have been 2 restructuring plans now, for tens of billions of dollars in estimated expenses. Ford's trying to get out of manufacturing or selling cars in the United States. It's going to switch to crossovers. The only car it'll have is the Mustang. It's trying to redo itself. It spent a lot of money on self-driving technologies. It thinks that that's going to be a thing. In San Francisco, we have the Ford bicycles. It's striking out in every direction. These Ford bicycles, these that you can rent. If Ford considered itself a transportation company, quote unquote, it's trying to get in every little thing. But when you have a car company fanning out like that into unrelated activities, they're struggling. Their core business is something that they're having a problem with, and they're trying to figure out what to do. And Moody's downgrade was related, I think, to the very opaque restructuring plans. They didn't really say much. There was one announced last April, and then there was another one announced, a bigger one, this during this last earnings call. And there's not a lot of information coming out how they're going to do it, except they're going to spend a lot of money. And every time I see one of those dang blue Ford bicycles in San Francisco, I'm thinking, good grief, this company needs to focus. It needs to focus on what it does, which is to manufacture and sell cars and vehicles, pickups and SUVs and cars, and start concentrating on that. It doesn't have unlimited resources, and it's just it's just turned into a dingbat of a company, and the stock has gotten crushed, and it's going to be harder for Ford to raise money. Now, I don't think it has financial problems. It's still profitable, and in terms of cash flow, it's doing okay-ish, and I don't think it will. I don't think it's a problem where it will default on its debt at this point, but it's just completely unfocused, and I think they now put a Silicon Valley guy in charge, and I think that's a big mistake. We see that with Elon Musk at Tesla. These guys don't know how to manufacture things. The manufacturing part of an automaker is really key. You have a supply chain to manage. You need to manufacture. Then you need to market these products. And you need to kind of focus. And Ford is just losing it in that respect. So, and I think that's what the Moody's downgrade was all about. And I've been down on Ford for 2 or 3 years, and I just don't think the company has any focus.
Europe offered free trade in automobiles to the U.S. administration, and that was rejected. What's behind that?
Well, right now, Europe is putting a 10% tariff, I think it is, on all imported vehicles from the United States. And the United States has a 2.5% tariff on European cars. And, of course, it has a 25% tariff on pickups. And but mostly what we import in the United States is cars and not pickups and crossovers and those kind of vehicles that do not have that tariff. So it's been uneven for many years. And one of the things that the United States would want is an even trade relationship. And Europe knows how to protect itself. I mean, it opens its mouth big when it comes to trade because it has a trade surplus with the rest of the world for good reason. Yeah, but it put dumping duties on Chinese steel long before that even came up in conversation in the United States. It protected its solar panel manufacturers. It's very quick in establishing trade barriers to imports, much more so than the United States. So when Europe speaks about trade, it is with utmost hypocrisy. They're especially Germany and France too, and in other countries, they're big exporters. They protect those exports and they protect their own borders from imports. And their United States exports a big part is services. You see that a lot with internet companies, and the European institutions are now going after the American internet companies such as Google and Facebook. So they're not angels in this respect, and the United States has a huge trade deficit. The entire world is taking advantage of it, except for Canada. Canada, we have a balanced trade relationship, and that's very unique for the United States. With most other countries, we have a huge trade deficit, and all these countries, the companies in these countries have been taking advantage of that. And the car companies in Europe, among the big, especially in Germany, those are the ones we import. We don't really import much from Fiat or from the French car makers, but the German car makers are heavy in the United States, and there's government policy behind it. Germany has a well-established, well-defined industrial policy. It's a mercantilistic country. Its number one priority is exports. It's the largest exporter. It has the largest trade surplus in the world, and it's pretty ruthless about defending it. So, the Trump administration is trying to figure out how to deal with it. I think it kind of messed up. I think the place to look really is corporate America and establishing your own industrial policy. You don't encourage offshoring of production. Now, Ford has a huge division in Europe, and the cars that it sells in Europe are made in Europe. And when I was a kid and I was living in Germany, I thought Ford was a German company. It is one of the most common brands, but they're all made in Germany. They're different models, and and that's how American manufacturers did this. GM had Opel in Germany. Opel was a German company that GM had acquired way back in the early 1900s, and it finally got rid of it. But their car makers are active overseas. American car makers are active overseas, but they build overseas and they sell overseas, and then they build overseas and they bring this stuff into the United States. And that's a real issue. This is something we should address, but it's really corporate America that we should address that with. And at the same time, the industrial policy that Germany and France have and the EU in general, it is something the United States has to deal with. It is not a fair relationship. You can see that by the numbers. The trade deficit of the United States has fattened up companies in those countries, and it is not fair. It is not even. It's not balanced. It has not benefited American workers. It's benefited German workers and French workers and German and French companies. But it's a deal that I think that needs to be shaken up. And the free trade that Europe offered, Europe didn't really offer that. It was by one politician in Germany, I think, who brought that forward. The trade relationships are negotiated by the EU for the European member states. So unless it comes from the EU trade office, it's really pretty meaningless. Our country cannot offer a free trade deal with a European country cannot offer a free trade deal of any kind. So this has to come from the European Union. And they're the last ones to offer really true free trade agreement with any country, because they're really careful about protecting their own industries and about protecting their exports. And they've been very good at it. They have a very tough negotiating position when it comes to this. They're very quick on issuing tariffs on imports when they feel like they're dumping, like this Chinese steel product, or solar panels or some of the other products. So yeah, this is something we'll have to watch, but I doubt that the EU will ever offer or sign a true zero tariff free trade agreement with the United States across the board. It's just not going to happen. You know, they're too protective of it, and they're too dependent on the export-oriented economies to do that.
What's the latest on Tesla?
It's a kind of a sad story in so many ways. You know, I'm a big fan of electric cars, but what Tesla is doing is just nuts, really. And I'm just hoping someday, somebody will buy Twitter and shut it down. It would accomplish two things. One, it would shut Elon Musk down, and his pronouncements over Twitter. And number two, we get the White House out of our hair for a while. And, Musk offered, or said in a tweet on August 8th that, there would be a buyout, that he would take Tesla private at $420 a share, and that, quote unquote, funding secured, so he would have the money to do this. It would take $72 billion. That has turned out to be a blatant lie. There is no funding ever secured. There was hardly any discussions on this. Nobody stepped forward. Last Friday night, Musk actually admitted that, in a blog post and said that, okay, that's not gonna happen and there's no funding. And, so this whole thing was a lie. And the original tweet, was done during trading hours, on August 8th. So during that time, the market capitalization of Tesla jumped by $6 billion. And just one tweet cost the market cap to jump by $6 billion. One tweet that was based on a lie. Now that is stock manipulation if I've ever seen it. The SEC is now investigating it. That issued subpoenas. This could get complicated. Now, at the same time that Musk said, yeah, it was a lie, and this is not going to happen, the board of directors of Tesla expressed its confidence in Musk and said that they would support him. That is, 6 members of the board said that. There's 3 members of the board that didn't sign that letter, and that's Musk himself, his brother, and another board member. So the board decided to not fire Musk over this, and or not to fire him at all, ever. Really, that's what they're saying. It doesn't matter what he says, they're going to keep him. And there's a reason for that, in that when you take him out of the picture, people invest in, for a lot of investors, Musk is a demigod, and whatever he says, and he's been making these fake promises for years now, and Model 3 production is an incredible mess. Manufacturing is, the supply chain, everything's just completely screwed up. And, the quality is lousy. They're not, the production numbers of 5,000, whatever, a week they're naming, these units are not finished, they're not being delivered. They're sitting on a lot somewhere. They're waiting for parts. They're damaged or not. The quality isn't right, and they can't get delivered. It's just a gigantic mess. And at the same time, nobody wants Musk to go because, shares would instantly collapse. Investors invest in the company because of him. When you just invest in the company as a company, there's nothing really there. They're making a few thousand electric cars, a month. It doesn't even really, it's not even a rounding error in total vehicle production globally. They're losing a huge amount of money. They're burning cash faster than anyone can count. The manufacturing operations are a mess. The supply chains are a mess. When you look at the company, it's just chaos, and it wouldn't be a penny stock. It would go out of business because the company needs to have a huge stock price to continue raising this money that it burns. And when the stock price goes down to, a few dollars a share, it can't issue the debt anymore, and it cannot issue shares anymore to raise the billions of dollars it burns. And so, it will go bankrupt. And everybody knows that. It's not a secret, This is just how the company is set up. It must have a high stock price in order to sell more shares when it needs more money so that it can burn more money. And the high stock price also guarantees the debt for creditors. So long as the bondholders are looking at this and they're saying, well, as long as the stock price is this high, the company can always issue more shares. So if they can issue more shares, they can get more cash and they can pay us off. So they don't perceive there to be any credit risk so long as the share price is high. But when the share price plunges, suddenly all bets are off, and the company is cut off from the capital markets. It cannot raise any more money. The only chance it would have is to turn its operations into something that's cash flow positive. And miracles have happened before, but I just don't see that. They have not made any progress in that direction. Every quarter that they're reporting bigger and bigger losses. So every quarter now for the last 6 or 8 quarters, it's been a record, and record loss, and that appears to continue. So, this is a situation where, or if they had just stayed a niche manufacturing company building, a few Model S's and X's and for wealthy people that want to drive a cool car and charge enough money for it so where the company could be profitable, that could have worked out. But trying to become a mass manufacturer, without having the manufacturing expertise to do so, that's just completely nuts. I mean, they have completely gone off the rails. And I think the investment community, especially the institutional investors, they've been with, Tesla since the beginning. They have a huge, amount of money in this. They've recognized paper gains on this and the many billions of dollars. They really can't get out because if they try to sell their shares, the stock would really collapse. And so they can ease a little bit, but they can't really sell. And, they have, too much money in it. And Tesla is heavily owned by these institutional investors that have been in it for many years. And, and when the stock collapses, they're probably likely to step in and buy a little bit more because they have to keep up the stock price as exposed as they are to Tesla. So this is the game that's being played right now. And the buyout offer was at $420 a share today. Tesla is at around little over $300 a share. So the stock manipulation was only good for one day, really. And Wall Street didn't believe it. Nobody believed it. The shares never went to $420 as much maybe had hoped, because everybody instantly knew there was no financing, there was no deal, there was nothing. It's just a lie. Meanwhile, the shareholders of Tesla hope, that Musk can somehow figure out how to keep this game going. And, and if later this year, he probably will have to raise more money. I mean, he says he doesn't, but chances are that Tesla will burn through its cash and will have to raise more money. And, if not later this year, then very early next year. And the financial markets have to be able and willing to give Tesla, a few $1 billion. And if not, if the financial markets decide not to do that, it's going to be very tough for Tesla to keep going.
We'll have more with Wolf Richter when This Week in Money returns.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. Work programs are underway in Finland and planned for Canada this summer. Arctic Star trades on the TSX Venture Exchange symbol ADD, on Frankfurt symbol 82A1, and the OTCQB symbol ASDZF. Please visit our website arcticstar.ca or call us at 604-689-1799.
I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead-zinc-silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic engineer gold mine in the Atlan District of Northwestern BC. Check us out at blindcreekresources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with Wolf Richter. Wolf, does the yield curve look like it could invert, and what does that mean?
The yield curve is the comparison of the yields of bonds, government bonds of different maturities. So if you plot on a chart today's yield of a 3-year bill, of a 3-month bill, of a 1-year, 2-year note, of a 5-year note, of a 10-year note, and of the 30-year bond, you'll get a curve. So with the lower end, so with the 3-month yield lower, and the 30-year yield higher. And that's the normal yield curve. So it's a line that curves upward. And one of the measures of the yield curve is the difference between the 2-year yield and the 10-year yield. And we're talking about Treasury securities here. And currently, the 2-year yield is at around 2.65%, and the 10-year yield is at around 2.86% or so. So the difference between the two is about 22 basis points between the two yields. And that's the lowest it's been since 2007, before the financial crisis. Typically, it's 1 percentage point or 1.5 percentage point difference. With 2-year yield might be 3%, and then the 10-year yield would maybe be 4, 4.5, or maybe even 5%. And that's kind of a classic situation. Now we're down to almost nothing. It's down to 20 basis points, and the basis point is 100 basis points is 1 percentage point. And this yield curve has flattened now, starting in 2014, where the difference has shrank. And part of that is because the Fed has raised short-term interest rates, so they have come up significantly. The 2-year yield was close to zero. Now it's at 2.65%. The 10-year yield has come up too. A couple of years ago, in 2016, it was at 1.5%. So now it's at 2.8, 2.9. It's been up at 3% earlier this year, and it goes up in spurts. So it goes up for a few months, and then it goes down a little bit, and then it goes up in another big spurt. And each spurt there's been 2 so far since the Fed started raising rates. Each spurt has been about 1 full percentage point, and then it just kind of struggles for a long time, and then there may be another spurt of a percentage point or maybe more. And right now, it looks like when the Fed raises rates again in September by 25 basis points, and the 10-year yield doesn't move, that actually the 2-year yield will be higher than the 10-year yield if the 10-year yield stays at today's rate. And so in that case, we call it an inverted yield curve, where the short-term yields are higher than the longer-term yields. And the reason why this is important, because in the past, every time this happened, this phenomenon, there was a recession afterwards. And the last time this happened, the financial crisis occurred. So there's some lag. The yield curve inverts, and then last time it inverted in 2006, and the financial crisis, the cracks started appearing in 2007, maybe late 2006, early 2007, and then the full crisis happened in 2008 or 2009. And so that was an example that's scaring everybody now. There's no cause and effect relationship between an inverted yield curve and the recession. It's not that an inverted yield curve causes a recession. It's more an indicator that there might be a recession coming, and that an indicator by the market, that the market thinks that there's a recession coming a year or two from now, meaning that the market thinks that 2 years from now, the 10-year yield will be low, and that it's therefore a good idea to buy the 10-year security now because you'll benefit from the yield situation that you'll have then. When the yields drop, prices of bonds rise. So a drop in 10-year yield will be a good thing for holders, for bond holders now. If you own a bond today and 3 years down the road, yields are substantially lower than they are today. The bond that you bought today would be worth more than it is today, and you could sell it for more, or you would enjoy a higher yield than people who would buy that bond 3 years from now. So this is a good situation in the calculus. If you're a bondholder today and you think that yields are going to be lower 3 years from now, you would buy more bonds today, and that causes a lot of interest in 10-year securities. Now, this relationship, even though between the inverted yield curve and the recession, this relationship has been solid, but now we have a completely manipulated bond market. You have a QE and you have artificially low interest rates around the world. QE has distorted everything. So a lot of people were saying that it no longer means the same thing. The Fed could just sell its long maturities that it has bought during QE. It could just sell them, and if you wanted to, and the QE unwind that it's doing right now, it's just letting maturing securities roll off. It's not actually selling anything. But if it decided to, it could sell the bonds it has in its portfolio with the longest maturities. It could sell those into the market, and the long-term yields would jump. And at the same way that it brought long-term yields down during QE. So there's a lot of discussion today what it actually means to see an inverted yield curve. The Bank of Japan is targeting the yield curve specifically. So it not only targets the short-term rate, it targets the 10-year yield. It says it wants a 10-year yield that's near zero but above zero, and it's doing that by buying or selling long-term securities. So these yield curves today can be completely manipulated all the way up if a central bank decides to do that. So the question is, does an inverted yield curve actually mean anything in terms of what it used to mean, that there will be a recession afterwards? Now, the Fed is raising rates to get a handle on inflation, and it's not even tightening; it's just removing accommodation, as it's saying. And what it explicitly wants to do, is it wants to increase the unemployment rate a little bit, and that's stated policy, so that unemployment will go from where it is now. It's right now in the 3% range. It goes up to about 4%, maybe 4.5% to maybe 5%, and this will slow down the economy enough to where inflation is coming down. That's the theory, but not enough to cause a recession. So that's the so-called soft landing. That's what the Fed wants to engineer. And in the past, they wanted to engineer that too, and usually it ends up being a recession. This time around, the Fed is raising rates very slowly. So it may raise 4 times this year, 1 percentage point. It raised 3 times last year, so 3/4 of a percentage point. It raised once the year before. So we're almost 3 years into the rate hike cycle now, and rates are not even at 3%. So in prior rate hike cycles, they lasted 2.5 years, and during that time, the Fed may have raised 5 percentage points. So it's going really slowly, and because it's going so slowly, the long-dated maturities, they're not increasing in yields, and at the same time, there's hope. And the financial markets have completely blown off the rate hikes in terms of stocks. And the rate hikes are geared to bring asset prices down. Now, that's part of the policy. Increase unemployment and bring asset prices down. Asset prices meaning, especially in real estate and commercial real estate. Commercial real estate has been pointed out by the Fed specifically as an issue, that they're inflated prices, and markets have blown off these efforts so far. And the Fed's going very slowly. It's going to maybe raise rates 4 times next year, unless it speeds up its pace. That's kind of what we're looking at. So it's glacial, that pace. And so the yield curve is an indicator that historically has been correct. At this point, we don't know whether the current central bank manipulation of the bond market have made the yield curve a meaningless indicator. And we also don't know if the Fed can actually engineer a soft landing. Central banks are not good at engineering soft landings, especially not from the inflated levels that we're at right now. And and if it is not able to engineer a soft landing, we will get a recession. And it's very likely that we get a recession, actually. I think it's very likely there will be a recession in a year or two. There hasn't been a recession in a long time. We're really due for a recession. An economy needs a recession. It's part of the natural business cycle. A recession is when, you blow out the cobwebs. That's when excess debt gets shed, when companies go bankrupt and consumers go bankrupt, and they get rid of the debts that they have accumulated. It shuts down zombie companies. It cleans out the corporate environment a little bit, and some of the corporate frauds are coming to the surface, and these kinds of things. There's a cleansing process associated with the recession that really should be allowed to happen, and that is natural. It's part of the natural business cycle. So I wouldn't be surprised at all. I mean, I expect a recession a year or two from now, and in that case, if the yield curve inverts this year, so the Fed raises rates one more time and the yield curve inverts, and then we do get a recession in 2019 or 2020, then the yield curve was once again proven as a correct predictor. But if somebody steals my bicycle today, and then 3 years later when we have a recession, or 2 years later I say, somebody stole my bicycle, that's a predictor of a recession. Once you get this far along without a recession, anything can become a recession predictor, because we're really due for a recession. There's going to be a recession. Recessions are not avoidable. We're going to get one. And they're important. They're useful. They're part of the business cycle. So, that whether or not the yield curve has anything to do with it, the connection there, other than being somewhat of a predictor, the cause and effect relationship has not been established at all. But I think we're going to get a recession, but I don't think that's what the yield curve means. The yield curve can invert, but maybe it won't invert. But we're definitely going to get a recession. I mean, that's guaranteed. You always get them. It's just a question of when.
We'll have more with Wolf Richter next on This Week in Money.
I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features through our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE, symbol CRL, and the pink symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
I'm Kelly Jennings, CEO of PowerBand Solutions. PowerBand is a cloud-based provider of auction, inventory, and finance solutions that make buying, selling, and financing vehicles more efficient. PowerBand Solutions trades on the TSX Venture Exchange symbol PBX and on the OTCQB symbol PWWPF and on Frankfurt symbol 1ZV. For more information, please visit us at powerbandsolutions.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with Wolf Richter. Wolf, what's the latest on the biggest housing bubbles in North America?
Well, we have so many indications right now, and there's contradictory data coming out. So the most up-to-date numbers that we have, so these dynamics that are taking place, beneath the surface in that various local housing markets, they're starting to deteriorate, including the inventory listed for sale is starting to surge in some markets by a huge number. The foot traffic is slowing down. We have all these kinds of indications. It takes longer to sell a home. homes are being pulled more often and relisted later, because they don't sell. At the same time, we have an index here in the United States, the Case-Shiller U.S. Home Price Index, that really lags behind. It's a 3-month rolling average. The numbers we got the other day were for June, so it goes back 3 months from June. So we're looking at the earlier part of this year, the spring season. And during that period, the home prices surged nationwide by over 6%, and in some of the local markets by a lot more, such as Seattle and others. Seattle has had a historic spike over the last 6 or 7 months. And if you look at the chart that I have, I mean, it's just a phenomenal spike. But in Seattle, too, now the underlying dynamics are changing and deteriorating. So it's really interesting to watch. The indices price indices that lag the market, they show large price increases even while the dynamics underneath the surface are deteriorating. And there's a fairly logical explanation for this, and that the housing market moves very slowly, and it takes a long time for prices to fall. But at the same time, prices have surged for so long that consumers have trouble buying homes, and now that interest rates are rising and some of the tax benefits from home ownership have been lost due to the new tax law, it's more difficult for consumers to buy these overpriced homes. So you see these two dynamics collide, and over the next few months and probably the next year or two, we'll see these dynamics work out in a way where, I think we'll look back at this period and see it as the peak of the housing bubble in those particular markets that are now the bubbliest. And that includes Seattle and San Francisco and some of those cities. In New York City, condo prices are already down year over year, so it's already impacting those markets. But in other markets, prices, especially the top bubble markets that we have in the United States, the prices are still up, but the fundamental dynamics are deteriorating. So I think when we look back next year, year after next, at this period, we will realize that that was the peak, that was it. That's when the market lost its enthusiasm. That's when consumers could no longer afford to pay these prices, and buyers became reluctant. And exactly when sellers become more motivated to sell and to put the house on the market. And that's what we've seen. The last couple of months, we've had a surge in those cities of inventory. Suddenly, there's all kinds of sellers coming out of the woodwork, and so the dynamics will take a while to play out. But I think when we look back, this will be it. This will be the turning point of the market in the bubbliest cities that we have in the United States.
What do you see ahead for the U.S. dollar?
Well, the dollar had a terrible year in 2017, and this year it bottomed out in February this year, and so since then it's risen pretty sharply. So it's not quite back where it was at the beginning of 2017, but it's recovered most of the damage of 2017. And it's up in the single-digit percentage points, but it's part of a package of problems in the emerging markets. And, we have two countries right now where the currencies are collapsing. I mean, collapsing is the right word, especially in Argentina. And over the last 2 days, the Argentinian peso plunged something like 24%, including today. Today, the central bank there raised its interest rates to 60%, 60. So 60.0. Now this is just huge. From 45%, which it raised, which it did in April 13th, and earlier, in April, interest rates were still in the 20s. So in Argentina, they're battling what was a currency crisis turning into a debt crisis has now turned into a financial crisis. And the IMF's already agreed to bail out some bondholders. There's a $50 billion bailout there. Argentina has now asked to speed that up. It's just collapsing there. In Turkey, And Argentina has a big trade deficit. It has an economy that's probably heading into steep recession. Inflation is over 30%. The central bank is part of the Ministry of Finance, so the central bank has been funding government expenditures for years. And the Argentine peso was at 1 peso to the dollar in early 2002 before they took off the peg. It's now about 2.5 cents. So it lost 97.5% of its value in those 18 years. So this is the loss today is not new. I mean, the peso has been doing that. The Argentinian government has been crushing the currency forever. My policy is nobody should ever lend Argentina money in a foreign currency. And that's the problem with Argentina. It's borrowed heavily. It owes $120 billion in foreign currency debt. It borrows in dollars because that's a lot cheaper. Because when your local interest rates are 40 or 60%, it's expensive to borrow. So it borrows in dollars, but then it can't pay off the dollars and it defaults. It defaulted in 2002 and it's going to default again. It's defaulted 6 times in the last 60 or so years. So this is just a regular occurrence. And this gets triggered by a tightening of the dollar. The people talk about the dollar getting scarce. It's not getting scarce in the emerging markets. It's just getting more expensive. And that makes it harder for those companies and governments to roll over the dollar debts and to service the dollar debts. Now in Turkey, a similar thing is happening, except they're doing the sort of opposite treatment. They're not raising interest rates, and they're not asking the IMF for a bailout. The Turkish lira has also plunged. Turkish banks face a major financial crisis right now. They've lent a lot in dollars and in euros, and now that the Turkish lira has plunged, and they've lent to companies and consumers in those currencies, and now that the lira has plunged, companies are defaulting on those foreign currency debts to those banks. So the banks are getting in trouble. Moody's has just downgraded 20 of those banks, and Moody's foresees major problems in the country, and it's getting worse. So these kinds of things, Argentina and Turkey were on the track to this fate. That was predictable. We've predicted it. We followed this. But it doesn't really get triggered until the dollar starts rising a little bit. That's suddenly when global investors are starting to look at other opportunities. So they're moving their money away from the emerging markets. They're starting to buy U.S. Treasuries and things like that because they're starting to look pretty good. If you can buy U.S. Treasury at returns 2.5%, or something like that short term, you don't lose your money. Emerging market debt returns 4 or 5%. And it has a huge risk associated with it. Suddenly it doesn't look that good anymore. So emerging market funds outflows have been very large, and so these predictable problems then actually happen, and then they're for market watchers, they're not a surprise. Some people act like this came out of nowhere, but this. We warned about this years ago, and this is the kind of stuff, that is very predictable, and now it's happening. The dollar increases, when the dollar rises 5 or 6% against the basket of currencies, and over a year period, or 8% over a year period, but over the same period, another currency plunges 60%. Or it plunges 25% in 2 days. That's not the dollar's fault. That's not the problem with the dollar. That's a problem with fund flows, how these, dollars and euros went into emerging markets, and now suddenly they're fleeing because they see the risks. And, the dollar will get blamed for a lot of things, but that's not the fault of the dollar. That's the fault of investors in those areas.
Wolf, is China's economy in trouble, and could that turn into a contagion affecting other countries?
China's economic growth has been funded with debt, and that debt is not blowing up, and that debt is not even known fully. So the government of China calls it the hidden debt, And this is debt that sits in off-balance sheet vehicles, often done by local governments and companies, and that was used to fund development projects of some sort, some infrastructure projects, or buildings or apartment blocks, that kind of thing. Yeah. And this debt is now blowing up, and the central government doesn't even know how much of it there is. Then you have state-owned enterprises that are hugely indebted. You have banks that are sitting on a lot of bad debt. The peer-to-peer lending in China that took off years ago, and there are hundreds, if not thousands, of peer-to-peer lenders. That entire industry has collapsed, and a couple of hundred of these peer-to-peer lenders have toppled. The Chinese government recently decided to essentially bail them out, and not necessarily the companies, but the investors. The investors are Chinese people. China's always worried about people demonstrating in the streets, and that's kind of the principle that when these retail investors are losing a lot of money, they start going down into the street and yelling and screaming, and the Chinese government is worried, and they'll have some kind of bailout. And the China has a lot of control. The Chinese government and the central bank are essentially a unified entity. The Chinese government owns the 4 largest banks. The government owns the largest enterprises, so the lenders are government controlled, the borrowers are government controlled. A lot of the local government entities are not necessarily controlled by the central government, but they're also supposed to respond to the central government. And so they have a lot more control over this. There's no market forces involved. It's, when debt blows up in China, it's not because the market blows it up. It's because it can't be repaid, and then the government is trying to figure out what to do with it. And bond defaults are still rare in China. It's because they're just essentially not allowed. So now the debt is blowing up, and this is debt that has funded economic growth. So China needs to continue to increase its pile of debt to fund economic growth. But now that it's trying to deal with the debt, and there are difficulties in increasing the pile of debt, even as a part of the pile is blowing up. And some of these development projects are put on hold, and so the consumer economy itself is probably not strong enough to overcome that. So it's gotten pretty strong, but consumers too are very much in debt now. I mean, consumers have bought apartments like other investors buy stocks. They're empty. They're investments. And if those prices decline, which they haven't yet, but if those prices decline, consumers lose a lot of their wealth. So, I mean, this is a very fragile economy, and the Chinese government is moving the levers to keep it from imploding. And unlike the United States government, they really can control a lot of things. They can make a decision to do certain things, and they can do it. They don't have to worry about property rights. You can't own land in China, so they can do all kinds of things. If they decide to build a high-speed rail line, they can just do that. So if they need to spend 20 or 30 or 50 billion on a big project, they can still do that. They can just decide to do that, and they can start that project, and they can, but it's debt funded. Everything is debt funded. So when you look at this, you realize, okay, this can't go on forever, but at the same time, the Chinese government has all these controls that no other government has, and they're using these levers to keep it going. And so people have been predicting for years that China would have a hard landing, that this debt bubble would blow up, and every time something blows up, there's a bailout. That more money gets printed quietly. The government takes on defaulted bonds. The government buys the companies, and I mean, it's just on and on and on. And so there's not going to be a market solution to this. It's just going to be more of these levers being moved around by the government. And so far, they've succeeded. To their credit, for years they have been able to keep going like this. And someday they won't be able to do it anymore. Someday something will go wrong, and one of the levers don't move, won't have any effect, and then you'll have a major situation on your hands. And when that happens, China's a huge economy. It's like the financial crisis in the United States. It impacts the entire world, and the same thing will happen with China. Now, Argentina and Turkey have a financial crisis right now, and it's not impacting hardly anything outside of those countries. But China isn't that way. When China catches a cold, the rest of the world will catch pneumonia.
Wolf, thank you so much for being on This Week in Money.
Oh, thank you, Jim.
My guest has been Wolf Richter, publisher of wolfstreet.com. He was speaking to us from San Francisco. Coming up, Ed Steer, next on This Week in Money.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the pink CYDVF, and on Frankfurt C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp. Inc., MGI on the TSX Venture Exchange. A 2015 drill program on the LH property intersected high-grade gold, including 16.9 meters of 13.58 grams and 11 meters of 20.66 grams per ton gold. A follow-up drill program is planned to further evaluate previously identified subsurface high-grade gold mineralization. Please visit our website at magnumgoldcorp.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. My guest is Ed Steer, founder of EdSteerGoldandSilver.com and a director of GATA, the Gold Antitrust Action Committee. He's speaking to us from Edmonton. Ed, welcome back to This Week in Money.
Always glad to be on your program, Jim.
Ed, before we went on air, you were talking about how it looked like gold and silver were going to do well, then back they go again downwards. Do gold and silver look like they have bottomed?
Well, it certainly appears that way, that we saw it a week or so ago that the bottom was in, but right now we're sort of in a back and fill area. As long as the powers that be can keep gold and silver below their respective 50 and 200-day moving averages, the managed money traders who are mega short precious metals plus other commodities are not going to be covering any of their short positions. They're going to just be sitting there. So they don't want these prices to rally above those marks until they absolutely have to or until they want them to. So at these price levels under these moving averages, the boys can do pretty much what they want.
How are the latest commitment of traders numbers looking for gold and silver?
Well, last week's numbers were like the week before, and for the last 3 or 4 months, they've been spectacular. And of course, last week's numbers were just were numbers for the record books and for the history books, because for most commodities, especially the precious metals, we've never seen numbers like them. I know silver analyst Ted Butler, who's been following the Commitment of Traders report for 20 years or 30 years, ever since it started coming out, says he's never seen anything like it, and he says we're locked and loaded for major moves up, not only in the precious metals, but other commodities that the managed money traders are mega short in right now.
What kind of an indication does that mean to you?
Well, personally, I talk to Ted almost daily, and as far as the Commitment of Traders is concerned, Ted's work on this is the premier work, because it wasn't for him, nobody would know anything about this, you, me, or anybody else. And I've been following it long enough to know that we're set up for, as what he calls, a locked and loaded situation for the prices to blow higher if the powers that be have that in mind. And I'm assuming that they didn't set it up for no reason at all, and that we are going to see some rather spectacular price increases before this is all over.
Because silver isn't just a precious metal, it's also an industrial metal used in computers and for solar panels. Could we see a silver shortage in the near future?
Well, that's possible. according to Ted, we haven't had a silver deficit since around 2008. There's always been more supply than demand, but it's not much. I think it's 100,000 ounces a day or something like that. So any kind of pickup in investment demand, even a small amount, would quickly use up that surplus, and all of a sudden we would certainly be in a supply-demand deficit in silver. It could happen almost overnight. I used to be in the retail silver business part-time, and I've seen the markets go from zero to out of this world in a matter of a few days or a week, and the supply lines for retail silver bullion are very long and very thin, and it only takes 3 or 4 days or a week's worth of big activity, and everybody from the refiner to the retailer is out of silver for months on end. So it could happen virtually overnight.
If there is a big jump in precious metal prices, what rises more, silver or gold?
Well, everybody asks that question, and there's no question about it. If prices were allowed, these precious metals were allowed to trade freely, silver would outperform and will outperform all the other precious metals by many orders of magnitude. There's no question about that.
We'll have more with Ed Steer when This Week in Money returns.
MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with Ed Steer. Ed, has J.P. Morgan accumulated an incredible amount of silver bullion?
Well, there's no question about it. I'm going to bring up Ted's name again because he's the fountain of all knowledge on this. He was the one that first discovered that they were collecting silver. Starting back when they opened their silver vaults on, I think it was 3 or 4 days before they slammed silver lower on May 1st, 2011, I think. And they've been accumulating silver in their COMEX vaults, and they got, 145 million ounces. Plus, Ted says they've been buying silver eagles and silver maple leafs and gold eagles and gold maple leafs for 4 or 5 or 6 years when there was just no retail demand at all. Plus, he says they're skimming from SLV and GLD, and they've been taking delivery of physical metal in the COMEX like they did just today. Last night they took delivery of, I think it was 1,600 contracts of silver, 1,300 for their own account, plus about another 360 for their clients. And they just keep stashing it away, and and they're not doing it, for any other purpose than to make just a pile of money on this someday when silver prices are astronomically higher than they are today.
Could a strategy for J.P. Morgan have been to short the paper silver market and buy the bullion?
Well, of course, that's what they've been doing. And, Ted's been following this ever since J.P. Morgan became involved 7 or 8 years ago, or actually since they took over Bear Stearns in 2008. And they've just been shorting the metal and buying the stuff up on the cheap, which of course is completely illegal, but the CFTC of course won't do anything about it. And they've been playing this market like a fiddle, fine Stradivarius, for the last 10 years now. And sooner or later that's going to come to an end, and the signs are that it's going to come to an end real soon.
If J.P. Morgan no longer shorts the paper silver market, what could it mean for the price of silver?
Well, they still have a small short position. Ted said last week that they're probably short around 10,000 contracts. But they have more than enough physical silver to, of course, cover that and much, much more. And if they decide the time is right for them and they're all locked and loaded, like I said, and ready to go, all they have to do is do absolutely nothing, put their hands in their pockets, go fishing, go on vacation. And the markets will do what they're going to do, and that's obviously blast higher.
We'll have more with Ed Steer when This Week in Money comes back.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Riaugh Shear Zone in Ontario, with grab samples running as high as 32 grams per ton gold. A follow-up drill program to test numerous targets located by recent groundwork is planned for early 2018. Please visit our website at rmroyalty.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back to This Week in Money. We're chatting with Ed Steer. Ed, is a triggering event needed for gold and silver to propel higher?
I've always made the assumption that when, because silver and gold and the precious metals and all other commodities, as a matter of fact, have been suppressed for so long, that when they are finally released to do whatever they have to do in a semi-free or free market environment, that some political, economic, financial, monetary event of rather large size, or more than one of these events will be occurring at the same time, and the powers that be will say, this is what set it off, or it was that set it off. It had nothing to do with us, because I just can't see something as ginormous as this happening in a news vacuum.
Are the gold ETF GLD and the silver ETF SLV backed by real bullion?
Well, there's been lots of speculation about this ever since they first came into existence 10, 12, 15 years ago. And my personal opinion is that the gold and silver that is said to be in those ETFs is actually all there. It would be a criminal offense of biblical proportions if it wasn't. And on something as major as that, I don't own any ETFs. I can tell you that right now. I do own bullion in paper form through, some of the mutual funds that are out there, but they are backed by physical gold. And I'm assuming that all of these funds out there are copacetic.
Do the banks really hold gold, or do they just shuffle it around to give it the appearance that they're holding a lot of gold?
Well, my personal opinion is that whatever gold they say they have, they actually own. But the problem with that is the fact that there may be paper derivatives written against it, and they may physically have it in the vault, but may be signed out to somebody else. So my bet is that yes, the gold is there, but the banks that have it in their possession actually really don't own all of it.
China, India, Russia, all trying to acquire as much gold as they can. What's the reasoning for that?
Well, they know perfectly well that the paper currency system led by the U.S. dollar is going to come to an end and within the foreseeable future. And they want to have as much of this as possible, and one of the things they can do is by they can get rid of their paper currencies, specifically the U.S. dollar, by converting it into a tangible asset, whether it be gold or silver or whatever. And Russia and China and India, like you said, Turkey and other countries have been accumulating gold for years now, and it's an open secret. I mean, all you have to do is check the Russian Central Bank statistics every month, which I do, and you can see how much they add. And they're going to keep doing this, and they're squeezing the physical market for all it's worth without letting prices blow sky high, which they would have done long ago if the New York bullion banks hadn't been sitting on the price.
Does the U.S. hold a lot of gold?
Well, we know this is a question that's been asked thousands of times. We know what they say they have, 8,100 and something tons in Fort Knox, West Point, and wherever. But is it actually all there? I don't know. What is the purity of that metal? I don't know. And like the other paper gold and other banks, how much of it is actually physically owned by them and how much they have, sworn out to other banks or financial institutions. It's a big question mark, and I can pretty much guarantee that if they did a physical audit on there and you could actually see what was going on, that the gold is either partially not there or spoken for elsewhere.
Canada and Britain sold off their gold quite some time ago. Should those countries start acquiring gold again?
Well, of course they should. And I think Britain and Canada sold off the gold because they were asked to sell off, because they had to. My opinion is that Canada sold its gold to help bring down the Soviet Union, and Britain sold its gold to save the bullion banks back in when the Washington Accord was signed back. It was in 1999 or whenever the heck it was. Because if they hadn't disgorged their gold at that time, the entire bullion banking system would have gone down the tubes, and that's the reason they sold. And I don't think they should be getting back into gold, but whether or not they're going to, I don't know.
Is silver in demand for electric vehicles?
Well, interestingly enough, I had an article about that in my column this morning, and there's no question about it. Anything that's high-tech electrical these days, whether it be an iPhone, a smartphone, or a computer, anything electronic at all has got silver in it. Of course, electric cars are the epitome of electricity controlled, and every electric car out there is going to have quite a bit of silver in it. So as the more and more cars are converted to electricity, more and more silver is going to be used. There's no question about that.
Should a U.S. dollar downtrend be good for gold and silver?
Well, you think that normally under normal circumstances it would be, but this last decline in the U.S. dollar index over the last couple of weeks, the bullion banks have been fighting the dollar decline hand over fist, and we haven't seen anywhere near the price rally for the last 2 weeks that we should have, because as you know, they beat the price down whether the dollar is going down or whether the dollar is going up. It's completely managed regardless of what the currencies are doing.
Are junior gold and silver stocks starting to attract some interest?
Well, if they aren't, they certainly should be. This is blood running in the streets time, and as I've written in my column on many occasions, this is when you put your money down and when things are ugly. And as Warren Buffett said, I'm fearful when others are brave, and brave when others are fearful. And this is one of the times that Warren Buffett, if he was buying gold stocks, and he isn't, would be putting his money down to buy precious metal companies, especially the juniors like this, because they're at rock bottom prices, and when the precious metals go, it'll certainly be reflected in the prices of the junior resource companies immediately.
Ed, what's new with the Gold Antitrust Action Committee?
Well, we still put, Chris Powell still puts out the GATA dispatches every day. There's, 7,000 or 8,000 names on that list. And so whatever's going on in the gold world or silver world, he keeps the media informed about it. And, Bill and Chris speak at whatever conferences. We give interviews like the one we're giving today. I speak in Vancouver a couple of times a year at the resource conference there. And pretty well everybody and his dog now, in the mining industry and every other part of the precious metals industry, whether it be investors or commentators, everybody knows the prices are being managed. And so we're sort of preaching to the choir after 20 years, and it's been almost 20 years since GATA first came along in, 1999. So this is all old news, and we're just getting tired of it, and we're all sitting here waiting for this thing to come to an end.
Ed, why do you think regulators have ignored all the information that indicates manipulation is taking place?
Well, in my opinion, the security SEC in the States, the CFTC, all the other major government or non-government entities are basically owned by the deep state. And they're told to basically ignore or not pay any attention to this because, the deep state has their agenda and the banking system and Wall Street has their agenda, and they're all part of it. And of course, when the stock markets and the bond markets and everything are riding high, the last thing they want is precious metals to come along and speak the truth about what those paper assets are really worth. So until there's a change of heart, or until the deep state decides that precious metal prices are going higher, which includes J.P. Morgan, by the way, we're going to see prices where they are. But the regulators have been told to look the other way.
Is it any coincidence that most central bank governors are former Goldman Sachs or J.P. Morgan personnel?
Not at all. Like I said, the American empire, if you wish to use that word, is is controlled through its, controls the countries and the banking system and the financial system through the financial markets, and the fact that they're in the IMF and the World Bank, and presidents of countries and central banks is no surprise at all, because that's what keeps the American dollar and the U.S. financial system and Pax Americana alive.
Ed, how can people find out more about your company?
They can just Google my name, Ed Steer, and my website will come up, edsteergoldsilver.com, and it costs $100 US for 200 plus newsletters per year, and they can join if they wish, because there's a sample column they can read so they can see what they're getting.
Ed, thank you so much for being on This Week in Money.
Thanks for having me on, Jim.
My guest has been Ed Steer, founder of edsteergoldandsilver.com. He was speaking to us from Edmonton. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Wolf Richter, and Ed Steer, and thank you for listening. Plus, stand by. At the end of the show, we'll have company showcase updates from American Manganese CEO Larry Reaugh, Aben Resources President Jim Pettit, and Carl Data Solutions Greg Johnston. If you have any questions for the show, you can send them to info@howstreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to the show, Larry.
Well, Jim, it's always great to be on the show.
Larry, what's the outlook for your company going into the Labor Day weekend?
Well, certainly you can see the market has been a lot stronger, so I think we did managed to get some investors out of the last conference we were at in San Francisco, and that's always a good thing. It shows that people are beginning to recognize the project, and it's just basically an exciting time for the company as we keep inching up the board. We're up about 30% from our low of 14, and that's got to be good news for the shareholders. Now, I've been reading in Reuters that they figure that the battery industry, the recycling industry, would be worth about $22 billion or $20 billion and a year within a decade, and so you can imagine it's worth a few billion today. So. Again, that's excellent news for us. I can say that we're starting to get contacted again by some of the companies that were talking to us early last summer, and then everything kind of went quiet. Now we're getting recontacted, and that's another good sign for the company. And we're just looking at some of the proposals and everything else we have. We're finding there's a much larger market out there for scraps than we initially thought. And, some of these companies are wanting to sell us the scrap at inflated prices. And, some are looking at some kind of a joint venture to actually garner the scraps. And I'm thinking this kind of leaves us in a bit of a dilemma, because it's no different than if you were, say, a gold mining company, and you built a mill to actually process other people's, a custom mill, to process other people's product, which is their ore. And there's a formula, and different formulas you can work out and how you can split the profits on that. So I'm really starting to investigate what would throw that out there, that perhaps because there's so many different companies that do have scraps, that perhaps we could enter into some custom milling, which would be our process agreement that would be beneficial for both sides. And I think that's where we're ending up. We can't just do one-on-ones. I think that eventually, because of our process, the scrap business will come our way. But it still means that there's going to be a cost. I mean, nobody's going to give you a ton of material that has a few $1,000s worth of cathode material for nothing. And so that's something that we have to work on. It's a good problem. And I just have to say that after this weekend, we'll be traveling all next week into the U.S., and so I won't be available on the phone, but they can certainly contact me at the office. And, I think we're closing out August, at least at this time of the day, on a very good uptick. Did you have any questions specifically, Jim?
Not specifically, Larry, but for new listeners, maybe just remind people what you've accomplished and what you plan to do.
Okay, we've accomplished a process that, as far as we and all our research can find out, along with some of the companies that are looking at us, we're the most advanced in a circular economy solution for recycling lithium-ion batteries. And that economy is a hydrometallurgical process that has nothing going back into the environment. It's a cradle-to-grave solution, and we get up to 100% of the cathode materials out. So we recently announced that some of the numbers we're getting, but when we do some lock cycles, those will increase. It always has for the lithium, and I think that now people are beginning to recognize it, and this is going to be a real busy fall for the company, because I think we're going to have lots of meetings, and we'll see just exactly where they lead.
Larry, where can people find out more information, and where is American Manganese traded?
American Manganese is traded on the Toronto Venture Exchange under the symbol AMY. It's traded in the U.S. under the symbol AMYZF, and it's traded in the Frankfurt under the symbol 2AM. And you can do due diligence on our site at AmericanManganeseInc.com. You can phone the company at 574-4444. The prefix on that 778. And you can email me at LREAUGH@AMYMN.com.
Larry, thanks for the update.
You're welcome.
I'm Jim Goddard. I've been speaking with Larry Reaugh, CEO and President of American Manganese. Our conversation took place on August 31st.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm Jim Goddard. I'm speaking with Jim Pettit, CEO and President of Aben Resources. Welcome back to the update, Jim.
Thank you very much, Jim.
Jim, you've just come back from Toronto. Are the people in Toronto finally waking up to the resource sector?
Well, there certainly seems to be a pulse. It's been a long summer. A lot out here. It's been a hot one and smoky. Back there, it's just been long and boring. There's a lot of whining, a lot of complaining. Resource sector hasn't been performing, and then all of a sudden there's been a few recent events that have caused some excitement. There's been this Sokoman, I guess it's a discovery in Newfoundland, a gold deal, which is good. Golden Ridge came out with a really good hole just north of us, actually, in the Golden Triangle, but it's a copper gold story, a big porphyry. and that galvanized the market a bit. And then our hole, from a few weeks back anyways, that really got things going, because that was, tremendously high grade and a continuation of where we left off from last year. So, and that story is still, the market on that is still good. It's strong. We've gone from 15 cents in that area, 15, 17 cents, to now 40 to 43, and trading really well in that range, and lots of volume, couple million shares every day. So there is a pulse. It'd be nice to see the broader market start to get some credit, but there's definitely interest in gold.
Jim, are gold prices high enough for a new gold mine to be profitable?
It depends on grade. What we find, let's say the Golden Triangle, that's an area that's known for high grade. SNP, for example, incredibly profitable. Only had 1 million shares. 1 million ounces were mined there, but they were almost an ounce, 30. I think it was 28 grams a ton average. You can make a lot of money with that. Without the massive processing facility. I think it was just crushed and the con was trucked out. It was, that's a nice thing to have. I mean, Pretium, they did do everything at a higher gold price. That's a big operation at a very, in a very extreme area. But I think they're still making money. SK operated at a very high grade for many, many, many years. And that when they made that discovery, gold was certainly not in these levels. So yeah, I think it is. I think your location is going to have a lot to do with it. CapEx has obviously become critical in today's era, and all-in sustaining costs are the new name of the game.
Jim, for people new to Aben, what are you all about, and where is all this action taking place?
Well, Aben's got three projects. Our main focus is the Forest Kerr property in the Golden Triangle, which is northwestern British Columbia. Very unique situation up there, very well known for high grades, and there's been so many mines in the area, past, present, and look like future. It's hard to compare with anywhere else. One of our other projects is in Saskatchewan, and we did pick that up so that we could have something to do in the winter. It's just south of the Athabasca Basin, east of L'Orange. Good gold project. It's ready to be drilled. So there'll be news flow through the winter. This is what we're hoping for. We started last year, but had there was the native band there was having an election. There was some sensitivity, so we basically stopped what we were going to do and pulled out and let them settle their differences, and we can move on from there. They would like to see us come back now. And the Yukon project is right next to Golden Predator, so that's another high-grade situation with a lot of potential. Our crew is going up there, basically next week, and we're doing a 10-day program, mechanically doing trenching and that, and we think we're onto something there. That's why we called it the Lost Ace, because 3 aces is right next to us.
Jim, where is Aben traded, and how can people find out more about it?
We're traded on the TSX-V under ABN, and the OTC QB markets under ABN.F. And they can reach us at any time. Go to the website. You can reach us through the website, or you can call 1-800-567-8181.
Jim, thank you so much for giving us all that new information.
You bet. Thanks a lot.
I've been speaking with Jim Pettit, CEO and President of Aben Resources. I'm Jim Goddard. Our conversation took place on August 27th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm Jim Goddard. I'm speaking with Greg Johnston, CEO and President of Carl Data Solutions. Welcome back to the show, Greg.
Thanks, Jim.
The company has just put out a news release. What's in it?
One of our customers has just won an award for a CSO notification. That's a combined sewage overflow notification. It's an environmental award. They won it in large part due to our software that they're using to monitor their sewage and stormwater treatment systems. It's a big coup for us because it's a new product that we had just released earlier this year. They were our first customer on the platform using the product, and we're quite happy that our first customer and our first sale is now won an award for it.
Is that encouraging for more research?
Not more research. We know that we have a big market, so more sales, Jim. We have there's an EPA requirement in the United States that's mandating all the Great Lakes Basin towns and cities to basically report on any combined sewage overflow events that take place, and we have the product that's in the marketplace to be able to do this. So we're the first ones to the plate on this one in getting it done and getting it in place. And the fact that the first implementation has won an award it speaks volumes for the work that our team has done.
Do you have new products coming online?
We have lots of new products this year. There's a bunch of products that we have released that are in pilot right now. They surround machine learning, which is something that is built into our applications. And these products do everything from detecting anomalies in data that help statisticians and data modelers ensure that they're not dealing with biased data in their data sets and when they're creating their models for cities or for companies. We also have infrastructure tools that dynamically generate models and show cities and municipalities exactly where their next big infrastructure project should be, because it shows exactly where in their systems, in their infrastructure, the system is performing subpar or at a very low level.
Greg, for new listeners, can you maybe give us a bit of a background for Carl Data Solutions and what it does?
Sure. Carl Data Solutions is a big data as a service company. We deal with large volume of information that we collect from environmental sensors. They're spread out through cities or in the case of companies throughout infrastructure, pipelines, dams, tailings ponds, things like that. And what we do with that data is we in real time analyze that information and then serve it up back to our customers in easy to read dashboards and web services so they can make smart, intelligent decisions about what to do.
Where is Carl Data traded?
Carl's traded on the CSE. The stock symbol is CRL, and we're also on the OTC. The symbol is CDTAF.
Greg, how can people get more information about the company?
For more information, send an email to info@carlsolutions.com.
Greg, thanks a lot for the update.
Thanks, Jim.
I've been speaking with Greg Johnston, CEO and President of Carl Data Solutions. I'm Jim Goddard. Our conversation took place on August 28th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.